Stephanie, step over here, please.
Excuse me, what is this about?
The catering
Missy?
cash you've been pocketing instead of depositing for the last...
Stephanie Ann Coulthard thought she had found the perfect gap in the system. She had been pocketing catering cash at this Panera Bread for 18 months, and one missing receipt is about to bring all of it down.
18
I have
months.
been a general manager for 7 years.
We
I
have
would never.
the invoices marked paid with zero corresponding
This
deposit.
is absurd.
You cannot just stand there.
48 hours from this moment, Stephanie Ann Coulthard would be sitting across a folding table from two corporate loss prevention investigators with a binder open between them. Inside that binder were 18 months of catering invoices, every single one stamped paid in full, and every single one missing from the daily cash deposit. $112,000, 341 orders, a separate ledger she kept in her own handwriting, locked in the bottom drawer of the office desk she had occupied since 2017. The investigation that brought corporate to her store had started with a single phone call from a law firm's office manager, asking a question Stephanie could not answer. Before we go any further, I want to ask you something. Have you ever worked at a job where you handled cash that nobody seemed to count twice? Drop a comment and tell me how that worked. And if you haven't subscribed to this channel yet, do it now. We expose people who exploit the gaps in the systems they were trusted to run, and we do it every single week. Stephanie Ann Coulthard was born in Gary, Indiana in 1983. Her father, Marvin, worked nights at the U.S. Steel coke plant on the lakefront and slept through the days with the curtains drawn. Her mother, Diane, was a unit secretary at Methodist Hospital's North Lake, the kind of woman who came home in scrubs that smelled like industrial laundry detergent and could recite every copay schedule for every insurance plan in Northwest Indiana from memory. The Coulthards lived in a brick ranch on Maryland Street, the third house from the corner, with a chain-link fence around a yard where Stephanie and her younger brother Devin spent every summer afternoon they could not get into the public pool at Marquette Park. She was the responsible one, the one who reminded her brother to bring his inhaler, the one who learned to balance the household checkbook at 13 because her mother worked doubles and her father did not trust banks. By the time Stephanie was in middle school, she was the one who paid the gas bill in person at the NIPSCO office downtown, counting out 20s from an envelope her mother kept taped to the inside of the kitchen cabinet. At Lew Wallace High School, her guidance counselor wrote on her senior file that she was organized to a fault, detail-oriented, and possessed of a quiet authority unusual for a student her age. She graduated in 2001 with a 3.4 GPA and a part-time job at a Denny's on Ridge Road, where she had been working since she was 16. She wore a black apron and a name tag that read Steph, and the night manager, a man named Curtis Pelfrey, told her on her second shift that she had the bearing of someone who would be running her own store by the time she was 30. He was almost right. She enrolled at Indiana University Northwest in the fall of 2001, intending to study accounting. She lasted 3 semesters. The tuition payments overlapped with a transmission repair on her mother's Buick Century, and Stephanie made the decision herself, without discussing it with her parents, to withdraw and take a full-time assistant manager position at an Applebee's near the South Lake Mall. Her starting wage was $9.25 an hour. Her first quarterly review described her as consistently meets expectations, works well independently, demonstrates strong cash handling discipline. She stayed at Applebee's for 6 years. She got married in 2005 to a man named Roderick Tisdale, a forklift operator at the Anderson Distribution Warehouse off Interstate 65. They moved to a 2-bedroom apartment in Merrillville, then to a small house in Hobart with a detached garage and a maple tree in the front yard. Their daughter, Aisha, was born in 2007, a son, Marcus, in 2010. In 2012, Stephanie applied for a shift supervisor position at a Panera Bread location off Mishawaka Avenue in South Bend. She had never made bread in her life. The district manager who interviewed her, a woman named Constance Leffler, would later tell investigators that Stephanie was the most prepared candidate I had interviewed in 9 years of hiring. She came in with a printed binder of her cash handling certifications, 3 letters of recommendation, and a sample weekly schedule she had drafted for our store layout. Stephanie was hired on the spot at $16 an hour. She was promoted to assistant manager within 14 months. The marriage to Roderick Tisdale, however, did not survive the promotion. He had wanted her home in the evenings. She was closing 4 nights a week. The divorce was finalized in 2015, uncontested. She kept the house in Hobart. He kept the Anderson warehouse job and a small apartment in Portage. The children stayed with her on weekdays and with him every other weekend. In 2017, Stephanie transferred to a higher volume franchise location in Indianapolis, on 86th Street near the Keystone at the Crossing Shopping Complex. The store was operated by a franchisee group called Heartland Bread Holdings, which owned 11 Panera locations across central Indiana. The 86th Street store was the highest grossing of the 11. It served the breakfast and lunch traffic for an office park that included 3 law firms, a regional hospital administrative office, and the corporate headquarters of an insurance subsidiary. The store also handled the heaviest catering volume in the entire Heartland portfolio. Stephanie was promoted to general manager in March of 2018. Her annual salary was $52,000, plus a quarterly bonus tied to food cost and labor percentages. Her performance reviews from 2018 through 2022 were uniformly excellent. The franchisee's regional director, a man named Bruce Halliburton, wrote in her 2021 review that she was the operational backbone of the 86th Street location. Catering revenue under her management has grown 41% year over year. She has not missed a single mandated audit window in 3 years. What Bruce Halliburton did not know, and what no one at Heartland Bread Holdings would know until the fall of 2023, was that the catering revenue growth he was praising in his review was, in part, an artifact of how Stephanie had learned to move money through the seam in his own accounting system. To understand how Stephanie Coulthard stole $112,000 from a national bakery cafe chain without setting off a single alarm, you have to understand how catering payment processing actually works at a high-volume franchise location. It does not work the way the front-of-house retail register works. It is a separate system, run on a separate ledger, reconciled on a separate schedule. And the gap between those 2 systems is exactly where the scheme lived. A Panera Bread store at the 86th Street volume level runs roughly 40 to 70 catering orders per week. Half-pan sandwich platters, salad bowls, hot breakfast pastries by the dozen, coffee travelers with stacks of paper cups and creamer kits. The orders come in 3 ways. Online, through the chain's national catering portal, which routes payment through a corporate processor and arrives at the store as a printed ticket with the customer's payment status already marked paid. By phone, directly to the store's catering line, which Stephanie often answered herself. And in person from corporate clients who walked in to confirm standing weekly orders, drop off purchase order numbers, or pay outstanding invoices. The in-person orders were the vulnerable ones. A law firm office manager would walk into the store at 10:45 in the morning, hand Stephanie a manila envelope, with $1,840 in cash inside and ask for a receipt for last Thursday's breakfast meeting platters. The cash payments were not uncommon. Several of the corporate clients kept petty cash floats specifically for vendor invoices under $3,000. Some did it to avoid the procurement bureaucracy of cutting a check. Some did it because the partner who ordered the breakfast wanted it expensed quietly. The reasons varied. The mechanism did not. Stephanie, as general manager, had sole signing authority on the catering invoice book. She had sole control of the office safe. She personally prepared the daily deposit envelope that an armored car service picked up every weekday at 4:15 in the afternoon. And she personally reconciled the weekly catering ledger that the franchisee group, Heartland Bread Holdings, submitted to corporate Panera every Monday morning. The vulnerability was structural. Corporate Panera's point-of-sale reconciliation software cross-checked retail register receipts against retail deposits in near real time. A discrepancy of $7 on a Tuesday lunch shift would generate an automatic flag that landed in Bruce Halliburton's regional inbox by Wednesday afternoon. Catering was different. Catering payments were reconciled against the catering ledger, but the catering ledger was a manager-entered document. The system trusted the general manager to enter the payment method honestly. There was no second layer of verification until the quarterly review, when a corporate auditor would pull a sample of catering invoices and request supporting documentation. The quarterly review pulled about 8% of catering invoices for verification. 8%. That meant 92% of every catering transaction the store processed in any given quarter passed through the system on Stephanie Coulthard's word alone. She knew this. She knew it because she had attended the franchisee's annual GM training in St. Louis in 2018, where a corporate trainer named Roxanne Devereaux had explained the catering reconciliation workflow to a room full of general managers in a hotel conference center off Lindbergh Boulevard. Stephanie had taken notes. She had asked a clarifying question about which line items got pulled in the quarterly sample. Roxanne Devereaux later told investigators she remembered Stephanie specifically because she was the most engaged person in the room. The trust framework here matters. Corporate clients trusted Stephanie because she was the face of the store. The franchisee trusted her because her numbers were good. Corporate Panera trusted the franchisee. The auditing system trusted the ledger. Every layer of the institution was built on the assumption that the general manager would not be the one stealing. The first one happened on a Tuesday morning in April of 2022. A paralegal from a mid-sized law firm called Ostrander Bain Whitfield walked into the store at 9:50 in the morning to pay for a breakfast platter order that had been delivered the previous Thursday. She handed Stephanie a white envelope with $480 in cash inside, mostly in 20s, with $150 on top. She asked for a receipt. Stephanie printed 2 copies from the catering printer behind the counter. She handed one to the paralegal. She marked the firm's invoice, paid in full, in blue ink. The paralegal thanked her and left. Stephanie put the cash in the office safe. She did not enter it in the catering ledger as a cash payment. She did not enter it as anything at all. She left the invoice marked paid in full and the cash sitting in the safe. At 4:15 that afternoon, when the armored car picked up the daily deposit, the $480 was not in the bag. It was in her purse. She later told one investigator, in a moment of unguarded honesty before her attorney arrived, that she did not plan to do it again. She told herself the $480 was a one-time thing. Aisha had needed new glasses. The orthodontist was asking about a payment plan for Marcus's braces. Her car had failed an emissions test, and she needed $800 in catalytic converter work to get the registration renewed. She told herself she would put the money back the next time the law firm paid an invoice. She did not put it back. The next time Ostrander Bain Whitfield paid a catering invoice in cash, it was $960, and that one went into her purse as well. The method, refined over the following weeks, was clinical. Stephanie kept 2 ledgers. The official catering ledger, which she submitted to Heartland every Monday, recorded only the invoices paid by check, credit card, or the corporate catering portal. The second ledger, a spiral-bound notebook with a dark green cover, lived in the bottom drawer of her office desk. The green notebook recorded every cash payment she pocketed: date of the order, name of the corporate client, amount. She kept it because she told herself she was going to put the money back. She kept it because she needed to know what she owed. The destruction of the duplicate receipts was the second piece. When a client asked for a receipt, she printed 2 copies, just as the system required. She handed one to the client. The other was supposed to be filed in the catering binder for the auditor to find during quarterly review. Stephanie did not file her cash payment duplicates. She walked them into the back office, fed them into the cross-cut shredder the franchisee had installed in 2019 for HR document destruction, and watched the paper turn into confetti. The pattern escalated. The first month, April of 2022, she pocketed 3 cash invoices for a total of $2,180. By July, she was averaging 4 to 6 cash invoices per month. By the end of 2022, she had taken just over $31,000 in 8 months. By the spring of 2023, the monthly total had climbed past $9,000 on at least one occasion. The single largest invoice she pocketed was $2,840, paid by the office manager of a small regional hospital administrative office for a board meeting lunch order in June of 2023. The signs were there, but the signs were quiet. Stephanie's personal spending shifted in ways a forensic accountant would later catalog with chilling specificity. She paid off Marcus's orthodontist bill in cash, $2,400 in a single Friday afternoon visit. She paid for Aisha's 8th grade class trip to Washington, D.C. in cash. She bought a used 2021 Hyundai Tucson for $19,000, putting $11,000 of it down in cash at a small dealership on Madison Avenue, and the salesman would later tell investigators he had thought it was unusual, but had not asked any questions because the buyer was a professional woman who knew exactly what she wanted. Her staff noticed nothing. The closing crew saw a general manager who stayed late on the nights catering invoices were paid. The opening crew saw a manager who unlocked the safe alone every morning and reconciled the deposit alone every afternoon. Bruce Halliburton, the regional director, saw a store whose catering revenue was, on paper, growing at a rate that won Stephanie the franchisee group's General Manager of the Year recognition at the Heartland Holiday Banquet in December of 2022. She accepted a plaque and a $500 Visa gift card. She thanked Bruce for his mentorship. The quarterly audits passed, 3 of them between the start of the scheme and the catalyst. Each time, the corporate auditor pulled a sample of catering invoices. Each time, the sample happened to include almost exclusively credit card and check transactions, because credit card and check transactions made up nearly 95% of catering payment volume. The cash invoices were the minority. The cash invoices Stephanie was stealing were a minority of that minority. The sampling math protected her for 18 months. It started with a receipt request, not a complaint, not a tip. A routine receipt request that should have taken Stephanie 90 seconds to fulfill. On the morning of September 12, 2023, the office manager of Ostrander Bain Whitfield, a woman named Pamela Bocage, was preparing the firm's quarterly expense report for the managing partner's review. Pamela had been with the firm for 19 years. She was the kind of office manager who kept her own ledger of every vendor expense alongside the firm's accounting software, because she had been burned once in 2012 when a copier leasing company had double billed and she had not been able to prove the discrepancy. Pamela did not trust accounting software the way she trusted her own paper trail. She was reconciling the firm's catering expenses against the petty cash float she controlled. One entry was missing a receipt. An 8-week-old breakfast platter order from Panera Bread, 86th Street location, paid in cash by Pamela herself on July 25, 2023. Amount, $1,840. She remembered the transaction. She remembered handing Stephanie the cash. She remembered Stephanie printing 2 copies of the receipt. What Pamela could not find anywhere in her file folder of Q3 vendor receipts was her copy of that receipt. She assumed she had misplaced it. She called the store at 10:20 in the morning and asked for the general manager. Stephanie answered. She recognized Pamela's voice. She knew the firm. She knew the order. She knew, before Pamela finished the request, exactly which invoice Pamela was talking about and exactly what was about to happen if she did not handle this carefully. Stephanie told Pamela she would pull the duplicate receipt from the catering binder and email a scanned copy by end of business. Pamela thanked her and hung up. Stephanie hung up the phone and sat in her office for a full minute without moving. The duplicate receipt did not exist. She had shredded it on July 25th. She had pocketed the cash. The invoice in the catering binder was marked paid in full, but there was no payment record, no deposit record, no transaction log, no evidence anywhere in the system that the $1,840 had ever existed. She spent the rest of the morning trying to fabricate one. She went into the point-of-sale system and attempted to enter a backdated cash transaction. The system rejected the entry because the date was outside the 72-hour adjustment window. She tried to reprint the original receipt from the catering printer. The printer kept no archive beyond 30 days. She considered telling Pamela that the receipt had been lost in a printer malfunction. She considered telling Pamela the order had been paid by credit card and she had given Pamela the wrong receipt by mistake. She considered briefly walking $1,840 in cash from her own purse into the safe and reporting it as a found deposit. She did none of those things. She emailed Pamela at 3:47 that afternoon and told her the system showed the invoice as paid, but the duplicate receipt copy appeared to have been misfiled. She offered to print a new receipt from the catering ledger as documentation. Pamela read the email. Pamela found the wording strange. A duplicate receipt that had been printed at the time of payment should be in a binder. A receipt being reprinted from a ledger 8 weeks after the fact, with no source documentation, was not the same thing. Pamela picked up the phone, not to call Stephanie. She called the corporate fraud hotline listed on the bottom of the most recent Panera Catering email confirmation she had received. That call routed to a loss prevention specialist at Panera Bread Corporate named Tomasz Wierczynski, who logged the complaint at 4:18 p.m. and forwarded it to the regional loss prevention manager for the Central Indiana franchisee region. By Friday afternoon of that week, 2 loss prevention investigators were quietly pulling the 86th Street store's catering records for the previous 24 months. By Monday morning, they had identified the pattern. Stories like this one rarely make the local news. A general manager at a bakery cafe steals $112,000 over 18 months, and unless a corporate client decides to push, it disappears into a civil settlement and a quiet termination. If you want to see more cases like this one, the cases where the institution would rather bury it than expose it, subscribe and turn on the notification bell. We don't let these stories get buried. The corporate loss prevention team worked the case in silence for 23 days before Stephanie Coulthard knew anything was wrong. The lead investigator was a former Indianapolis Metropolitan Police Department detective named Russell Vandekamp, who had retired from the city after 26 years in white-collar and financial crimes investigations and had been working corporate loss prevention for the Panera franchisee group since 2020. Vandekamp was meticulous. His partner on the case was a younger investigator named Ingrid Schoberg, a forensic accountant with a master's degree in fraud examination from the University of Cincinnati. Together, they pulled every catering invoice the 86th Street store had processed between January of 2022 and September of 2023. The total was nearly 4,300 invoices. They cross-referenced each one against the daily deposit logs. They cross-referenced each one against the weekly catering ledger Stephanie had submitted to Heartland. They cross-referenced each one against the corporate POS transaction log. The credit card and check transactions matched cleanly. The corporate portal transactions matched cleanly. The cash transactions did not match at all. 341 cash invoices had been marked paid in full in the catering binder. Of those 341, only 48 appeared in the daily deposit logs. The other 293 had never made it to the bank. The total of the missing deposits was $112,460. Vandekamp and Joberg interviewed the corporate clients next. They contacted Pamela Bocage at Ostrander Bain Whitfield. They contacted the office manager at St. Vincent Heart Center's administrative office, who had paid 4 cash invoices totaling $6,840 across the 18-month period. They contacted the procurement coordinator for the Regional School District Administrative Office on the North Side, who had paid 14 cash invoices totaling $19,200 for monthly board meeting lunches. They contacted 17 corporate clients in total. Every single one of them confirmed the same pattern. Cash payment delivered to the store. Receipt received at the time of payment. Some clients still had their copies of the receipts. Stephanie's copies of those same receipts were not in the catering binder. The physical evidence came next. On the afternoon of October 5th, 2023, while Stephanie was out of the store on her scheduled day off, Vandekamp and Schoberg conducted a documented inspection of the general manager's office under the franchisee's standard audit authority. They photographed the desk. They photographed the safe. They photographed the cross-cut shredder, which still contained at the bottom of the catch bin paper confetti that the forensic team would later partially reconstruct into 31 identifiable cash receipt fragments dating from the previous 90 days. And in the bottom drawer of the desk, under a stack of vendor catalogs, they found the green spiral notebook. The notebook was the smoking gun. 18 months of cash invoice entries. Each line entered in Stephanie's handwriting. Date, client, amount. The handwriting was confirmed against Stephanie's signed performance reviews and her weekly catering ledger submissions. There was no ambiguity about authorship. There was no ambiguity about purpose. The notebook tracked, in clean columnar entries, every single dollar she had stolen. The The forensic team also pulled Stephanie's personal financial records under a court-approved subpoena. Her bank deposit history showed a pattern that aligned almost perfectly with the cash invoice schedule in the green notebook. Cash deposits of $200 to $400 made at the ATM of her credit union 2 to 3 times a week, dating back to the spring of 2022. The deposits never exceeded the federal currency transaction reporting threshold. They were structured to stay invisible. Text messages recovered from her personal phone, pulled later under a separate warrant, included an exchange with her sister-in-law dated July of 2023. Sister-in-law, July 9th. You good on cash for the trip? I can spot you. Stephanie. I'm fine. Work has been busy. Catering took off this summer. Sister-in-law. Okay, girl, get yours. Stephanie. Trust me, I'm getting it. A second exchange with a friend named Brandy, dated April of 2023. Brandy. How are you affording all this? Like seriously, Stephanie. Catering bonuses. Bruce keeps bumping my quarterly because the numbers keep going up. Brandy. Girl, that's amazing, congrats. There were no catering bonuses of that size. Bruce Halliburton's bonus structure for general managers topped out at $1,200 per quarter. Stephanie's documented bonuses across the 18-month period totaled $3,800. The remainder of the lifestyle escalation was the cash from the green notebook. By October 24th, Van de Kamp and Joburg had a complete case file. The franchisee's general counsel reviewed it. The decision was made to terminate Stephanie's employment immediately, demand restitution as a condition of avoiding criminal referral, and refer the case to the Marion County Prosecutor's Office regardless. They decided to terminate her at the store on a Tuesday morning with the regional director present. On the morning of October 31st, 2023, Stephanie Coulthard arrived at the 86th Street Panera Bread at 5:42 a.m., as she did every Tuesday. She unlocked the back door. She turned off the alarm. She started the bake program in the oven array. She brewed the first pot of dark roast for the opening crew, who would arrive at 6. She unlocked her office. She opened the safe. At 7:15, while she was on the floor walking the breakfast rush with her shift supervisor, a man named Curtis Beauchamp, the back door buzzed. Stephanie walked back to let in what she assumed was the dairy delivery. It was not the dairy delivery. It was Bruce Halliburton, the regional director, accompanied by Russell Van de Kamp and Ingrid Joburg from Corporate Loss Prevention, and a fourth person Stephanie did not recognize. A woman in a charcoal blazer who introduced herself as Marina Lichtenberger, Associate General Counsel for Heartland Bread Holdings. Bruce asked Stephanie if they could speak in her office. He did not smile. Stephanie walked back to her office. She sat down behind her desk. Bruce, Marina, Van de Kamp, and Joburg arranged themselves in the small space, 2 seated, 2 standing. Van de Kamp placed a black binder on the desk in front of Stephanie. Marina spoke first. Stephanie, I'm going to start by telling you that this conversation is being documented. You are not under arrest. You are not in police custody. You are an at-will employee of Heartland Bread Holdings, and this is a workplace meeting. You can end this meeting at any time. Do you understand? Yes, Stephanie said. Marina nodded at Van de Kamp. Van de Kamp opened the binder. He turned it around to face Stephanie. The first page was a photocopy of the green spiral notebook, open to a page dated June of 2023. Stephanie looked at the page. She did not speak. Stephanie, Van de Kamp said, we have conducted a full audit of the catering operations at this store going back 24 months. We have identified 341 cash catering invoices marked paid in full that do not appear in the daily deposit records. We have interviewed 17 of your corporate clients. We have recovered from the bottom drawer of this desk a notebook in your handwriting that records each of those transactions. The total is $112,460. Stephanie did not look up from the page. Do you want to tell us anything? Vandekamp asked. There was a long silence. Marina watched her. Bruce watched her. Sjoberg, who would later describe the moment to a colleague, said Stephanie's hands stayed flat on the desk and her shoulders did not move. Stephanie was, Sjoberg said, the calmest person she had ever sat across from in a fraud interview. I want to talk to a lawyer, Stephanie said. Marina nodded. That is your right. I'm going to inform you that, effective at the conclusion of this meeting, your employment with Heartland Bread Holdings is terminated for cause. You will be escorted from the premises. Your store keys, your safe code, your point-of-sale credentials, and your franchise email access have already been revoked. Loss prevention will accompany you to retrieve any personal belongings from this office. Stephanie nodded once. She stood up. She picked up a framed photograph of Aisha and Marcus from the corner of the desk. She picked up a Panera branded coffee mug. She walked out of the office with Vandekamp and Sjoberg flanking her, past the breakfast rush at the front counter, past the line of customers who did not look up, past Curtis Beauchamp at the register, who watched her go and did not understand what he was seeing until 2 hours later, when Bruce Halliburton gathered the staff in the back of the house and told them their general manager had been let go. She drove home. She did not call a lawyer that day. She called her mother. The Marion County Prosecutor's Office received the case file from Heartland Bread Holdings on November 9th, 2023. The case was assigned to a deputy prosecutor named Adelaide Pinkerton, who had been with the office for 11 years and specialized in property and corporate fraud cases under Indiana's Level 5 felony theft statutes. Under Indiana Code Section 35-43-4-2, theft of property valued at $50,000 or more is classified as a Level 5 felony, punishable by a sentencing range of 1 to 6 years in the Indiana Department of Correction and a fine of up to $10,000. The state can also pursue corporate fraud charges under separate statutes when a fiduciary relationship and a systematic course of conduct are established. Pinkerton charged Stephanie with 1 count of Level 5 felony theft and 1 count of corporate fraud. Stephanie retained a defense attorney named Garrison Vexelman, a former public defender who had built a small practice in Indianapolis, representing white-collar defendants on plea-negotiated dispositions. Vexelman's approach, communicated to Pinkerton in their first phone call, was straightforward. His client would not contest the underlying conduct. She would make full restitution. She would accept a felony conviction. What she was asking for was an executed sentence served as community corrections, not as incarceration, on the grounds that she was a first-time offender, a primary caregiver to 2 minor children, and a candidate for the kind of supervised disposition that Indiana judges routinely approved for nonviolent property offenders who entered restitution agreements. The pretrial proceedings began in January of 2024. Stephanie's initial hearing was conducted by Judge Wendell Strothman in Marion County Superior Court, Criminal Division 3. She entered a plea of not guilty pending pretrial negotiations, which is standard procedure for a defendant who intends to negotiate a plea agreement rather than try the case. Restitution was the first hurdle. Heartland Bread Holdings demanded full restitution of $112,460 as a condition of supporting any plea disposition that did not include a prison sentence. Stephanie did not have $112,000. The cash she had stolen had been spent. The Hyundai Tucson she had bought in cash was now in the driveway of the house in Hobart, which was the only significant asset she owned. Vexelman negotiated a structured restitution agreement, $35,000 paid up front from a refinance of the Hobart house, with the remainder paid over a 60-month schedule. The corporate clients who had been victimized were also given the opportunity to file victim impact statements with the prosecutor's office. Pamela Bocage, the office manager at Ostrander Bain Whitfield, whose receipt request had broken the case open, submitted a written statement that Pinkerton would later read into the record at the sentencing hearing. Pamela wrote, "I trusted Ms. Coulthard. Every Friday for 2 years I walked into that store and handed her cash from our firm's petty cash account, and every Friday she handed me a receipt and a smile. When I asked her for a duplicate of that receipt in September of 2023, she had every opportunity to tell me the truth. She chose to lie to me by email instead. The amount she stole from my firm was not the largest amount she took from anyone, but the betrayal is the same. She was the face of a brand that was supposed to be reliable. She was not reliable. She was a thief in a manager's apron." As of the most recent pre-trial conference in the spring of 2024, Stephanie Ann Coulthard remained out on her own recognizance, awaiting a final plea hearing in front of Judge Strothman. The expected disposition, per the negotiated plea framework, was a sentence of 3 years executed as community corrections, with 2 years of formal probation to follow, full restitution as a condition of the disposition, a felony conviction on her permanent record, and a prohibition on holding any position involving cash handling fiduciary responsibility for the duration of her probation. She will never manage a store again. She will never sign a deposit slip again. The bakery cafe chain that promoted her to general manager and named her general manager of the year in 2022 has scrubbed her name from every internal document the franchisee group could locate. The 86th Street store has a new general manager, a man named Donovan Kessler, who was transferred in from the Carmel location and who, on his first day in the office, found the green spiral notebook had been removed. But the bottom drawer of the desk still had a faint indentation in the wood where the corner of the notebook had rested for 18 months. Her children are still in the house in Hobart. Aisha is 16 now. Marcus is 14. They know what their mother did because the local news ran a small write-up when the charges were filed, and because kids at their schools saw it. Stephanie works now at a customer service phone center in a corporate park off 82nd Street, taking inbound calls about cable billing disputes for $10.90 an hour. She is 41 years old. She has a felony conviction pending. She has 55 more months of restitution payments to make to a franchisee group whose General Manager of the Year plaque is still in a box in her garage. This case was infuriating, but the next case on your screen right now is on a level that has to be seen to be believed. Click it now.